For today, the Bank of America looked at how the US rate cuts affects the stock market and found that the results depends on whether a recession follows. When a recession happens after a rate cuts, the global stocks usually fall. But if the economy stays strong, the stock tends to rise significantly. Right now, the indicators suggest a positive economic outlook, meaning that the recent rate cuts by the Fed might be a good sign for the market. The main question for the investors is why the Fed is cutting rates. If it's because of the recession is coming, that could hurt the stocks. If the cuts are meant to manage the inflation, the stocks might benefit. Additionally, in times where there's no recession, the stocks are more sensitive to economic changes, generally performs much better than those considered safer. In contrast, during a recession, the safer stocks tend to do better, so the overall market response to rate cuts really hinges on the economic situation at the time. And then for the oil prices have been dropping because of the signs that Saudi Arabia might increase the oil production and drops its price lower. This news is weighing on the market, even though there's strong demand for fuel and lower crude oil inventories in the US. Concerns about the global demands and the potential returns of Libya to the oil market are also putting pressure on the prices. Overall, the outlook for the oil remains uncertain, especially as major economies show weak demands. The geopolitical tensions in the Middle East adds to the uncertainty as any conflict could disrupt the oil production and cause the price to spike. However, with the weak global demand, it's hard for the prices to stabilize and they might keep fluctuating. And last, for the gold prices reached a record high of 2,685 recently, with the US dollar that has started to recover from the previous losses. The positive US economic data suggests a smooth transition, and factors like the China stimulus policy and tensions in the Middle East are also driving up the gold prices. Even with the strong US stocks and the rising bond yields at the 10-year slightly increasing to 3.798%, the dollar index is holding steady at 100.91. The market is expecting the Fed to implement more aggressive easing policies, which keeps investors optimistic about the gold. The recent data shows significant growth in the US economy in the second quarter of 2024, and a job initial claims indicates that the labor markets remain strong. Overall, this combination of factors is supporting the rise in gold prices. And that is all for today. Thank you for watching.